Committee meeting of September 12th, 2023. Madam Secretary, will you please provide the roll call?
When your name is called, please answer with here or present. Member Frost, Member Killebrew,
Here.
Member Pagano,
Here.
Vice Chair Michelle,
Here.
Chair Ms. Kua.
Present. We will now move on to public comments.
For the record, all members of the Financial Review Committee are present with the exception of Member Frost.
Sorry, jumped the gun there. Public comments. Madam Secretary, are there any public comments?
We have no public comments at this time.
All right, we'll move on to new business. So the first item is approval of minutes from the April 25th, 2023 Financial Review Committee meeting. Any comment?
I make a motion to approve the minutes as stated.
Second.
Okay, can we call for the vote?
Member Frost, Member Killebrew,
Yes.
Member Pagano,
Yes.
Vice Chair Michelle,
Yes.
Chair Ms. Kua.
Yes. Fantastic. The next item is the alternative investment options and PFM presentation. So we'll have a staff report and then a committee discussion.
Yes, so today we have Kyle Tanaka and Leslie Murphy from PFM. They'll be giving a presentation on their camp program and their managed portfolio services as well. So let me get this going.
Who's doing the presentation?
We both are. Leslie will handle the.
Okay, I'm gonna move over here.
I can hear you, Steve. Can you hear me?
Yes.
How do I get back to the
Alright, Leslie. Presentation's up and running.
All right, excellent. Well, let's jump right in. Good afternoon, everyone. Nice to meet you all virtually. Thanks for making time for us this afternoon. So my colleague Kyle Tanaka and I will be presenting some information to you. And we've already reviewed some of this information with C and with Cheryl in terms of how your funds are currently managed and some strategies that we have in mind for you that you can access through our firm, PFM Asset Management. So if we want to advance to the next slide.
I'm trying, Leslie. There we go.
There we go, perfect. A little bit about us, our firm, PFM Asset Management, we've been around for about 4 decades, 43 years to be exact. I've been with the firm for 17 years, and Kyle, I think, is coming up on about 5 years with PFM Asset Management. In total, we manage about 214 billion assets in assets under management and advisement nationwide. We manage funds, any high quality fixed income, so anything from short-term liquidity management and enhanced cash, 1 to 3, 1 to 5, or 1 to 10 year mandates, which is mostly what we'll be focused on today. But we do also offer our outsourced chief investment officer solution, which is really more appropriate for longer term funds. Think funds set aside in a Section 115 trust for something like future pension or OPEB obligations. Moving on to the next page.
Actually, can you go back to that page? What's the difference between discretionary asset under management and asset under advisement?
Great question. So discretionary assets under management are assets where you would say, PFM, here's our investment policy, manage to our investment policy. You don't have to get sign off for each and every buy and sell as long as you're meeting our investment policy. Whereas assets under advisement, we have a little bit less discretion. So in that case, our portfolio traders would identify an opportunity, send it off to the client. The client would say, yes, PFM, execute, or no, PFM, we don't want to go that route right now. It's just our level of discretion.
And under any of those options, do you actually hold the investments, or where do they reside?
Great question. So all of our client assets are held by a third party. We recommend third party custodian or trustee. we never take possession of the assets.
Okay.
Great questions. A little bit more about our experience here in California. So as a firm, PFM has been managing funds in the state of California since 1989. We only manage institutional funds, and here in California, we've been managing public agency funds specifically since 1989. We have about 175 clients throughout the state, including 67 cities. In total, we have about $72.5 billion in assets in California, and that encompasses both discretionary and non-discretionary assets. We're very active and regular educators and members of various industry organizations, including CSMFO, CMTA, CACTAC, CSDA, and AQUA. So all the alphabet soup of the public finance community here in California. And because we have such a strong presence and we've made such an effort to educate our clients in California, we do have very significant experience with both California government code and investment policy development. And at the bottom right, we just show a few of the California cities that we worked with, totaling about $8.3 billion in discretionary assets managed for cities in California alone. Moving on to the next couple of slides. So enough about us. We wanted to talk about you and how we would partner with the city of Dana Point and our approach to managing your investment program. So we'll talk today. We have a couple of different options we wanted to discuss with the committee, kind of see what's of most of interest to you. But regardless of the specific strategy that you choose, our holistic approach is the same. So we always, number one, put communication and client service first and foremost. You know, it's really our philosophy that the best type of client is an educated client. So it's our goal that you always know how we're managing your funds and why. So to that end, we provide transparent and timely communication of portfolio and market information. We have comprehensive reporting available and fundamental investment education. As an example, and we do offer monthly webinars specifically to our clients in California, talking about our views on the market and how we're managing client assets accordingly. We'll also perform a cash flow analysis, and you'll notice a check mark beside this one. C really was very, very helpful in providing us historic cash flow information. So with that information, we were able to put together a cash flow analysis and forecast for you, which we're going to step through today. So hopefully that's helpful to you just in thinking about your historical cash flows, what we project as your future cash flow and growth trend. And from that, you know, that data really helps us to determine the appropriate allocation between short and longer term investments. The city, as you'll see, has experienced very significant and very steady growth. So now you're at a time where you can think about perhaps taking somewhat of a longer investment strategy if that's appropriate for the city. And finally, that all leads into bullet point number 3. With the information that we have and that we'll discuss with you, we'll look to develop and implement a customized strategy that really works for the city and helps to meet your goals and objectives within your risk return parameters. So Kyle, if you want to move to the next slide, just a quick snapshot again, kind of highlighting that communication and education that's available to you. We offer timely market updates, monthly reporting. We're available for in-person and virtual meetings. I am based out of the San Francisco office, so I'm joining virtually today, but Kyle works out of Los Angeles, so he's a little bit closer to you. But in addition to that, we also offer 24/7 online account access. In terms of education opportunities, we do offer customized workshops, special webinar offerings to address developing market events, and as I mentioned earlier, those monthly webinars available exclusively to agencies in California. Additionally, we do also have a team who does a lot of research, and they publish a lot of thought leadership pieces around monthly market updates, white papers, educational pieces, webinars, and other tools. And kind of part and parcel with this, we do pay close attention to any changes to California government code that impact the investment of public agency funds here in California. So a lot of our clients really look to us as a valuable resource when you're looking to update your policy every year. Moving on to the next slide. So let's kind of take a look at the cash flow model. So our model does analyze historic balances. It determines seasonality and other seasonal factors, but really the most value we think is that the cash flow model really helps to identify the appropriate mix, the appropriate allocation between funds that need to be kept shorter term, what we think about as liquidity funds, versus funds that can be invested longer term. Hopefully, knock on wood, we're coming out of the current inverted yield curve environment, but longer term history tells us that there is benefit in investing funds a little bit longer term. You pick up a little bit more yield and a little bit more return that way, but you want to make sure that you still have enough funds liquid to meet those day-to-day cash needs and also to provide an appropriate liquidity buffer to accommodate any unanticipated cash needs. So that's really what our cash flow analysis helps us to do. It helps us to think about what's the appropriate allocation for funds that need to be kept liquid versus those longer term core funds that can be potentially invested a little bit longer term. So moving on to the next slide, we can actually see your data. So this is looking at data that C sent over to us between January of 2019 and current, and this is showing us your actual balances. So a couple of the things jump out to me from this page. Number one is your growth rate at about 11.7%. So that's pretty significant growth rate. Secondarily, you are maintaining very sizable liquidity balances. Now, this is something that we see a lot, particularly in internally managed funds. You probably don't have the staff to be out buying and selling individual securities in the market. So it makes sense to keep ample funds liquid. And again, with the inverted yield curve environment, we were in an environment where we were seeing higher yields on overnight liquid funds than longer term funds. But kind of the way to read this, the light blue shading is where you currently had your core funds, so some of those longer term investments, versus the darker blue shading shows your historic short-term portfolio, which is largely invested in LAIF right now. And that gold dotted line shows where we think you could potentially invest longer term. So what our analysis is telling us in this case is that you might have about 26.9 million in what we call investable liquidity. So looking at your historic cash flow patterns, you've never dropped down below that amount, and you've seen that historic growth pattern. So if you wanted to, you could potentially invest additional funds in that core portfolio up to about $27 million in additional funds to that core portfolio. If you want to move to the next page, this is where I think it really gets interesting. So this is where our model allows us to project out future growth. So based on the information that we have for about 4 years and counting, your portfolio balances or your overall investable asset balances have grown by 11.7%. So very, very significant historic growth there, nearly 12%. And our model shows projected out for the next couple of years where we think your investment balances could end up by January of 2025. If that growth pattern holds steady, you'll be at about $70 million all in. So the way that we calculated this, and again, the shading kind of delineates what could be invested in the core portfolio versus what could be kept liquid. We are assuming a 15% liquidity cushion. So you'd never want to draw that liquidity pot all the way down to zero. That makes everybody nervous if an unexpected bill comes up. So we are projecting a 15% liquidity cushion here. So Kyle, I want to go ahead and move to the next slide. So this is just a snapshot of your existing portfolio at June 30. So total funds available, just shy of $64 million. The chart in the bottom left shows you have about 62% in cash or LGIP, that's largely invested in LAIF. and about 38% that's rated AA. That represents your U.S. Treasury holdings at 38%. So again, your portfolio, you do have some core funds invested now. You've got a good healthy chunk in liquidity, and as is appropriate for an internally managed fund, very, very high credit quality investing in U.S. Treasuries, because you probably just don't have the staff on site at the city to really monitor the creditworthiness of other types of obligations like corporate notes or commercial paper. So again, very highly creditworthy. Your average market yield at June 30th at about 3.64%. Again, largely reflected in the fact that a lot of those funds are invested in LAIF. So with that, I will switch gears and hand it off to Kyle so he can talk about CAMP and the CAMP program and how that fits into the whole scenario and the investment strategy for the city.
Yeah, thank you, Leslie, and thank you all for allowing us to come in today. I think to level set first, when Leslie and I were talking about, and when we started engaging with C and Cheryl and the city, for us it was really about an opportunity to present you with multiple investment options. So where Leslie just talked about portfolios and having PFM manage a portfolio, this is a completely different option available to the city. So to me, this is a investment vehicle or a decision similar to the city, how the city has decided to invest in LAIF. CAMP in itself is a joint powers authority, local government investment pool. Similar to Leslie, it was created in 1989. So again, when PFM came out to California and really started building its business out here. For the pool itself, you'll see characteristics on the left-hand side. To me, it really comes down to, and just for the city itself and local agencies in California, it comes down to safety, liquidity, then yield. And if you fail any of those standards along the way or can't get comfortable with it, then yield should be the last consideration. So when we talk about safety, we talk about external reporting to S&P. So it's AAA CAMP, the pool itself, is rated AAA by S&P, the highest rating for local government investment pools. To maintain that rating, we require weekly reporting out to S&P. So that's kind of the first thing. Then, let's say if we satisfy the safety standard, then you move down to liquidity. So now CAMP has a 11 a.m. cutoff time for wires in and out of the program. And I do think when CAMP was created, it was really meant to be a tool. And so you'll see unlimited transactions, which is going to be a different than the state pool. Also, there's a not set dollar amount that you have to transact in. For LAIF, for example, the state pool, you have to transact in $5,000 increments. Similar to kind of a PFM approach, you will have an online, if you decide to move forward with CAMP, you'll have access to an online portal. That'll look the same both from a managed account side and from a just pure CAMP investment side. You do have the option to open multiple sub-accounts. We see this specifically for projects or bond proceeds. And then there's no minimum investment. The one caveat there is that if one of your accounts, your main account or a sub-account that you establish goes to zero balance after a year, it's automatically closed. Another difference between LAIF or the state pool and CAMP is that our interest is paid monthly, so you have the ability for more compounding there. There are no additional out-of-pocket expenses. That's a nice little bullet point to say, but quite frankly, it's similar to any pooled investment vehicle you would consider. And then specialized service for bond proceeds, I mentioned already. That's really the reason or why CAMP was originally created. As we've grown over the years, it's really turned into operating funds as a vehicle more so than bond proceeds. So with that, quick look at our portfolio from July, or the end of July. So you'll see total fund assets were just above 14 billion, so 14.1. I checked earlier today, and I believe we closed at 13.4 billion. Our weighted average maturity, 33 days. I'll come back to that on another slide of why that's important. You'll see the current 7-day yield on this, or at the end of July 31st, was 5.43. I believe today, Leslie, you might have to correct me because I don't have my pad in front of me, but I believe we were at 5.54%.
You're on the money, Kyle.
There it is.
554.
And then I'll also, when I talk a little bit more about weighted average maturity, I'll also come back to net asset value and why that's important for a dollar. Below the two pie charts, you're seeing the sector composition of what we're buying in the portfolio. This can change pretty frequently, but I think for me, when I look at the sector composition, it reminds me to talk about that CAMP, since it is a joint powers authority and California public agency. It's bound to 53601 government code, the same as the city. So you'll never see anything in the portfolio that is outside of that scope. That's really the foundation on which the pool can invest into. And then credit quality, I mentioned that, just highly rated. And this is for our camp pool, or what I would call our traditional offering. So I mentioned LAIF, and it's actually fortunate in this scenario that the city invests a lot of money with LAIF, because I think this helps kind of put them side by side. So really, you see again the rating, but that middle graph, or the middle bar chart, the weighted average maturity. So roughly, there's been about a spread of 200 basis points, or about 2% between our pool and LAIF over the past 8 months. And it's all because of the weighted average maturity of the pool. So that's saying essentially how often your assets will turn over. So if we juxtapose that with the accelerated rising interest rate environment that we've been through, you can see that our pool assets are turning over, able to invest in higher yielding securities. It's not that we're better than the state, it's that they're two separate vehicles in terms of what they're aiming to do. So there will come a time, just back in 2020, March of 2020, when the Fed came in and slashed interest rates to 0, we fell down faster and then stayed at the bottom longer. So again, they are somewhat apples to apples, but they're also kind of very two distinct investment vehicles. Again, you see the monthly, quarterly. The last is the investment limit. That's an internal camp decision for itself. It actually dates back to an old IRS rule, but it's a way that no shareholder can have adverse effects on the pool greater than 10%.
What's the performance difference, like say over 5 years, 10 years?
It would really depend on going back to the rate environment that you're in. So in coming out, so 5 years ago, through 2018, we started to see some interest rate hikes, right? So anytime, it would be a rising rate environment, we're going to be outperforming LAIF. In a stable environment, it depends on the previous environment. So for instance, now the anticipation would be that we're hopefully getting ready to enter a prolonged, or not prolonged, but a stable rate environment. That yield spread between the two pools is so significant that you won't see a movement, and you would need rate cuts to happen by the Fed before you start to see those yields coming back to one another.
But in a normal yield curve, or the positive yield curve,
Yeah.
I mean, they're gonna perform better.
They're going to perform better,
Yeah.
yes. And so really, with the discussions that we have now is when you see an extreme environment, one way or the other,
Yeah.
that's when you shift your percentages, essentially.
Yeah.
So, and then with that, the $1 net asset value, I want to take a second on that. So CAMP follows GASB 79, which allows for the accounting of a stable NAV. The reason why that's important is that it allows us to say for every dollar in, you can get a dollar back out. And part of the criteria for managing the pool and the fund this way is that we have to maintain 10% daily liquidity of the entire fund in daily liquid instruments. Taking it a step further, there's a 30% requirement for weekly liquid investment instruments. Again, points to why the WAM is as low as it is, or the weighted average maturity is as low as it is. But that's really kind of the I'd say juxtaposing the two pools is that you have a really short-term pool option, and then you have a kind of a more intermediate option, and then even taking a step further, you'd probably look to the Orange County pool as a longer duration investment pooled option available to the city.
Yeah, and just to kind of amplify Kyle's point, we never recommend that clients completely close out of your LAIF account and move absolutely everything over to CAMP. You always want to keep both options available to you, because as Kyle mentioned, they'll perform differently in different rate environments. So that way you have the two strategies that are managed a little bit differently. In a rising rate environment, you might shift the balance to CAMP. In a stable or falling rate environment, you might switch the balance to LAIF. That way, you keep all of your options available to you.
What about, in reference to comparison from Leif and Camp, basis point that you guys take for fee?
Yeah, so camp's fees are right around 10 basis points, I believe, based on our asset size now. They're 9 point blah blah blah, but I call it 10 basis points as a fair fee on the fund. I believe Leif has an administrative fee, but it's minimal. I believe 5 basis points or something to that effect, Leslie.
Yeah, that sounds right. I don't think it's any more than 5. And all of the yields that you see quoted from us, and it should be all the yields that you see quoted from Leif, are net of fees.
Yeah.
To make it a little bit easier in that respect to compare the two.
And you said you were a JPA, so you're like not-for-profit?
Public agency itself,
So-
Camp is.
Camp is.
Yeah, and so Camp,
PFM's contracted to.
correct. PFM is the investment advisor and the administrator of Camp. So it's a contract with the board of
Oh, I
trustees.
see, okay. I see. And who executes the trades?
PFM does this.
PFM.
Yeah, so PFM, just as, let's say the city wanted to entertain hiring PFM as the
Yeah.
investment advisor, Camp has done the same thing.
So then we tell the custodian to take your trades and you're authorized to execute trades, basically.
It's a little bit more active on if the city had established a Camp account, you would be then making the decision yourself as to what you would allocate the same way as you would with Leif. So your funds typically come from, let's say if you wanted to move 5 million from Leif, you would move those funds out into your bank and then you would place a wire or an ACH to then move those funds into Camp.
We
So the
can't-
So the custodian, we send the money to the custodian and they send the money to you, to Camp.
Usually not a custodian in the standpoint, it's usually coming from your bank. So go into your whoever the bank is for the city.
Yeah, with Leif, we can only transfer
Yeah.
funds to and from our Bank of America checking account, basically.
Got it.
So we would be taking money from Leif to our B of A account and then transferring it over to Camp.
Okay, I guess I'm a little confused when you said that we had a custodian that held the money.
US
Camp-
Bank.
Camp has a custodian.
Yeah, Camp has a custodian, it's US Bank,
I see.
so that's, yeah.
Okay.
Sorry for that.
That's all right.
Briefly, just to mention this, we launched, I mentioned multiple investment options. Really, I think the decision from the committee is on the pool, the traditional offering. We just launched Camp Term this last February. The best way I can describe it is that it's a CD-like program that operates under kind of a pooled environment. We're pretty proud of it. It is wildly different than the traditional offering. You'll notice there's a $1 million minimum there, as well as you see the maturity range from 60 days out to a year. So it's really trying to replace that in between of what the traditional offering to where a core portfolio like Leslie's been talking about would sit.
Mhm.
To me, I think kind of going back to my standard, the way that you would even access this program is that you would move funds into the traditional pool, and then you would place a transaction for, let's say, $1 million into Camp Term. So I think that's a longer discussion and something that if you all wanted us to come back and talk a little bit more about Term on, we could do that. But this is just a heads up that we launched it this year.
Staff's recommending participation in the pool.
Yeah. And so similar, this is just talking about our online access, so it's similar, like I said, to the portal that you would have from the PFM Advantage side as well. All right, Leslie, or are there any more questions about Camp or? All right, Leslie, you're back up.
All right, thanks, Kyle. So kind of going back to the core portfolio option. So I know Kyle alluded to this earlier. It feels like maybe we're jumping around a little bit, but since we have your time and attention, we did want to present kind of the full array of investment solutions to you so that you know, so that you have all the information in your back pocket. So Kyle talked a lot about the Camp Pool, which again, fully liquid, a good alternative to Leif. You're not giving up liquidity. Just in the today's rising interest rate environment, you're picking up a little bit on yield, and it's a very, very safe investment. If you wanted to think about a longer term strategy for those core funds that typically haven't been touched, that have been building up over time, that's when we're going to talk about the separately managed account for your core portfolio. So if you wanted to go this route, a few differences versus the CAMP program that Kyle talked about in the core portfolio, these securities would be held in a custody account at US Bank or whichever bank you wanted to choose in the name of the city. So again, we don't own these securities, they're owned by you, but we would manage them for you. So this is what a sample portfolio could look like. We pulled this data as of the end of August. So if you said, okay, you know, PFM, maybe 6 months, 9 months, 12 months down the road, we're ready to start investing longer term in a core portfolio. We talked to you about some different strategies. A lot of our clients like kind of the 0 to 5 year strategy, gives you a little kind of a laddered portfolio. So you're buying at different maturities. And now this is under your current investment policy, what we could do for you. In a 0 to 5 year strategy, the duration of about 2 years, a gross yield here at a 5.17. So keep in mind gross yield. For the separately managed portfolio, you would have to subtract our fees off of that, which we'll show you later in the presentation, kind of to ballpark at about 10 basis points. So your net yield here would be about a 5.07. This would again be managed within the constraints of your current investment policy, so very highly creditworthy, about half of the portfolio invested in US Treasuries, the remainder in federal agencies, federal agency mortgage backed. We do have room in your current policy to add a little bit of corporate exposure in the way of commercial paper and negotiable, so think easily tradable certificates of deposit. So still very highly creditworthy on the bottom left. Credit quality, 79% of the portfolio is allocated to AA. Again, that's largely that Treasury and federal agency bucket, and a very diverse duration distribution. So you're not putting all of your eggs in one basket. You have the funds now that you can do a more diversified, separately managed portfolio. We wanted to move to the next page. If the city wanted to think about expanding its current investment policy to allow for more credit exposure, again, within the constraints of California government code, we can walk you through what the changes would be to your investment policy to get you there. We would talk a lot more about our credit resources and our credit research capabilities. But quite frankly, a lot of folks do tend to hire a firm like PFM because we do have very robust credit research capabilities. So they're comfortable saying, yes, PFM, you know, we rely on your credit research within the constraints of California government code, which limits us to very highly creditworthy fixed income instruments. So if you were to go full California government code, you can see a much more colorful sector allocation chart. Again, the US Treasuries are still going to be a very large part of your portfolio, 25%. Another 20% in federal agencies across the board. You can see we're adding some additional sectors, including supranationals. So think obligations of the World Bank, municipal securities, again, that commercial paper and negotiable CDs, but also feathering in some corporate notes and AAA rated asset-backed securities as well. So this is maybe, you know, a few steps down the road, but if you were comfortable with this more permissive investment strategy, you do, as you expect, pick up a little bit in yield. So on a gross basis, 5.28 here compared to 5.17 under your current more restrictive investment policy. Once you back out our 10 basis points of fees, you're looking at about a 5.18 in yield here. Again, very similar duration distribution, and we're seeing the credit quality here in the bottom left as well. So moving on to the next page, to be fully transparent, you know, here are our fees,
Excuse me,
starting at about 9
Leslie,
basis
excuse
points.
me, Leslie.
Leslie, hold on one second.
Sure.
Staff's recommending at this point to add the pool option, but we're getting the full sales pitch for all your other services. I'm just not sure if that's where staff wants to go at this point.
Well, we had talked to PFM because it's been a while since I think this committee and the city council has kind of looked at different investment type options.
15 years.
Yeah, so I'd asked PFM to kind of just
Okay.
lay out all the different options. We are only recommending to do the pool at this point. Historically, we've just had the laddered portfolio of treasury notes in the 1, 2, 3, 4, 5, and then when the one matures, we get another 5-year, and then everything else in LAIF. We try to keep a 50-50 between treasuries and LAIF, but because, as Kyle was talking about before, when interest rates were almost zero, it didn't make sense for us to put more money into treasuries. So now that environment has changed, and in fact, we did that $8 million treasury note just a few months ago with our additional community investment account money to get in on some of those higher treasury note rates. Right now, when you're looking, because of the Fed's activity and raising interest rates, treasuries are still, with the inverted yield curve, are very, very high, the shorter term. And then I'm getting these, looking at different pools and noticing the shorter period, average maturity term, they're getting over 5%. And I'm like, and I'm looking at LAIF, and it's crawling at a snail's pace. So that's when I reached out to Kyle. I'm all, how you guys, and so he explained it all. And I'm just thinking, 8 months ago when these rates were starting to go up, if we had had that camp account, we could have put some of our money in LAIF into the camp and benefited from those higher yields without having to lock in more treasury notes. We could have done that too, but I think the liquidity, because I think the city's always tried to do something very safe, very conservative type investing. I think this provides us with that same safety and security and liquidity that LAIF does, but we can manage between the two, depending on, like right now, we probably want to put some more money in camp because we're getting a 5.5% compared.
Camp is fully liquid.
Fully liquid. The
Same
pool.
day liquidity.
And
Yeah.
what you're showing here is so we could dip our toe in the pool.
Yes.
Yes.
And then we're looking at our next steps potentially.
Yes. Yeah.
So just for history purposes, the city's investment policy where it is today was formulated back in 1994 on the heels of the Orange County pool bankruptcy, where the city had money in that pool, and they switched over to adding LAIF and having a portfolio of 2-year T-notes at the time.
Mhm.
I'll say 15 years ago, we took a run at talking with some investment advisors, bringing them into the FRC to even just loosen it up and be able to invest in some government agencies. And that was the kibosh, just stay where we're at. And that's where we are today, but I think, there's definitely some different options without incurring too much risk, if you will.
Is staff recommending a specific amount?
So we would need to update our investment policy to allow for us to participate in a JPA pool. Right now, all we have is LAIF as far as pooled in our investment policy. And then staff is looking at maybe, because right now it's kind of, in our investment policy, we don't have specific percentages. It's just from practice that we've worked through with the investment committee. So it'd still be, try to get 50% in treasury notes, and then 50% liquid in either LAIF or camp, with up to 25% in camp. And the city manager would have discretion on moving, because the city manager is also our city treasurer, would have discretion on moving the funds back and forth. And like the interest rate environment doesn't switch, like it's not like next month, unless something, the feds go crazy and decide to push interest rates to zero. It's not like we're going to be flipping money back and forth from LAIF. We'll probably be able to keep things into camp until we start seeing the Fed starting to cut rates to the point where LAIF is kind of catched up. Then we can like move more money over there.
So, but about how much would you go initially, do you think? Just ballpark.
We're looking like 25%. 25% of the portfolio. And the portfolio, so the most recent treasurer's report, which was in July, the total portfolio value is about 60,000 or 60 million. So we'd be putting Cause right now we have over 50% of the portfolio in Lake.
Late.
So that would be 50% of 60 and half of that,
25%.
Yeah, 25% of 60.
15
so
of it.
15
Yeah.
million.
Just
I
to
mean,
kind of look at,
The only observation I make, I'm just looking at the fee table, and I hate looking at the fee table, but, so I look at that and it says, I mean, it's relatively nominal, right? 9 basis points on 50 million is 45,000, right?
so that's on the separately managed account.
Oh, that's under separate.
So can you
Ours
roll
was
back
10,
to the,
right? 10 basis
Yeah,
points. didn't they?
so
I
on,
said 10.
sorry Leslie,
That's what I heard.
I'm jumping around on you here. So when I talked about the fees, for camp specifically, it's off of the total assets under management of the fund. So it would be 10 basis points off of the 14.1 billion. And so that's why it's not a direct cost
So
to
there's not a
the
minimum.
agency. There's no minimum.
It's the same 10 basis points, no matter what.
Correct, that you're not realizing that, it's already taken out of the yield
Got it.
for the overall fund
So
before the
there's no
dividends
minimum
are paid
percentage,
out,
got it.
yeah.
Okay.
So you won't see a fee schedule
Understand,
all of the
understand.
See, do you expect any transaction costs if we start moving it in between?
That's what it is right there. The
There-
wire?
there
You mean-
yeah, a wire,
Or staff time? I mean, I love the idea, I think you ought to, I'm not sure why
it'd
you
be
limit it to 25%, but.
it'd be minimal staff time. I mean, we look at it like moving the money in between the accounts is like right now when I move money from Leif, I go in and move the money and it's, if I do it before 10 o'clock, it's in our B of A account. And same reverse, and it would probably be very similar with camp. So it's really not significant staff time.
Yeah. I mean, my only view on it is that, you know, just like in a normal market, which is like, say 90% of the time, more, we're in an inverted yield curve market right now, which is an anomaly. But in a normal market, of course, the longer duration, the higher the yield.
Mhm.
Otherwise, why would you have it? So basically, Leif is higher, it should outperform camp, you know, in a normal yield curve environment. I get this whole thing about interest rates coming down and there's some timing issue there, but normally it's just the normal yield curve. So yeah, you expect Leif to be better, so I think, I mean, I have no problem diversifying. I mean, diversification is like the #1 rule, so, and it sounds like it's a pretty good portfolio. So you're invested short, you know, either way.
Yep.
I mean, the one criticism I said when I was interviewed for this Saul was, they said, what could you do for us? And I said, nothing. Because you guys have such good sound financial policies, the one thing that stands out is how conservative your portfolio is. I mean, it's like, whoa.
I said the
That's
same
so
thing when I
conservative.
came here.
Yeah, but I mean, you know, and then something happens and then you pat yourself on the back for being so conservative, so. I don't think there's anything wrong with being that conservative, but I do like the fact that you can diversify, you can easily move money around. If you don't really like this product after 6 months, a year, you move it back to Leif, if Leif, you know, whatever, you know, so I have no problem with it.
Why is staff recommending only 25%?
I think because the philosophy right now is 50% treasury notes, 50% Leif, split the difference between, and plus this, like you said, we're probably going to long-term have more money in Leif than camp. Camp is kind of like, when the interest rate environment is right, at least we have that option to go in there and get a higher yield. I did look at some of our neighboring cities' recent treasurer's report, and quite a few of them have at least 2 different pool options.
Oh.
So it's safe. It stays with the city's policy of being conservative and safe. We're not asking to do anything out crazy. You know, the government code really doesn't let us anyway. But it helps us do something a little different than what we have to maybe get a little bit better yield in the right environments.
With your other cities, well, on average, how much of their portfolio do they have with camp?
It varies and depends. Right now, I mean, I think in the environment that we've just really lived through, you're gonna see a significant overweight to cities that have come in and that for any of their pooled funds, I'd say majority are probably seeing in between an 80 to 20% allocation when it comes to Leif and camp. But it'll depend. Some people or some other cities have kept just a basic set balance, and that's all that they've maintained for the program, because ultimately it's a liquidity vehicle too. And so city of Bakersfield, ever since that they went into financial hardship, they said regardless of rate environment, we're keeping $100 million as our mark in the program at all times. So it depends from city to city, but right now you would expect to see higher percentages just because of the overweight, because of the environment.
Is there any reason to believe there's a different risk between Leif and camp, or did I miss that? Did you guys already go through that?
I think the only risk is if for whatever reason we just kept everything in camp and all of a sudden the interest rate environment changed and we didn't move to Leif when Leif is doing better.
Yes.
So it's just us making sure that we're monitoring the interest rate environment and that make sure that we're getting the most out of our available portfolio.
Did you mean that or speculation on the investments? Like,
I meant speculation on the investments, but I
Yeah.
mean, maybe there isn't, and if there isn't a significant difference in risk between the two, I don't know why we'd limit it to 25%, just conceptually. It's liquid. I don't mind if you're moving it back and forth.
I think the risk you have by not having it is the opportunity for us, so.
And
By not having this opportunity like this last year, if we had $15 million in camp,
yeah,
it's probably, you know, $300,000-$400,000 in lost interest, so.
pickleball
Yeah.
courts.
It's a pickleball court.
No, this is great, see,
I
this
think
is really smart.
When rates start coming down, you're gonna wish you had locked in longer duration.
Yep.
Okay.
Right now, the rates are short, you're like, I wish I could be rolling that 5.5%,
So
but when
we're,
rates go down.
so that's why
Okay.
we'd keep the laddered portfolio, and like next month, we have a treasury note that's going to mature.
Yeah.
So we'll reinvest that money, but because of the interest rate environment, we might actually take a little bit more
Okay.
of our
Yeah,
liquid.
you should.
Yeah, cause I think, I looked at the 5-year note, and it's like 4.6.
Yeah.
It closed yesterday.
I mean, the thing about it, you're, and very guilty of all this, say this, but that's an investor saying, I'll take a a lower yield on my long-term investments. They're putting their money where their mouth is. They're basically saying, rates are coming down. And 99% of the time, they're right. So rates are coming down. Wait to buy that new house.
Are you moving?
I'm not.
So yeah, so staff's recommendation is to, make a recommendation, so we would have to bring back investment policy. We would do that at the October FRC meeting, because we also need time for our auditors to look at the changes in investment policy to make sure we're still in compliance. And then we would be taking a recommendation to city council. We're having a meeting, the first meeting in November, correct?
Correct.
To allow us to open a camp account and adopt a new investment policy.
I'll move just to get us going, I'll move the recommended action, that staff puts together, a policy to participate in the California Asset Management Program Cash Reserve Portfolio managed by PFM Asset Management. And
Is there a
take that
second?
to council.
I'll second that.
Okay, can we call for the vote?
Member Frost,
Yes.
Member Killigrew,
Yes.
Member Pagano,
yes.
Vice Chair Mitchell,
Yes.
Chair Macevoy.
Yes.
This motion passes by a vote of 5-0.
Cool. You get to go?
I fly up to Sacramento, drive 2 hours to Chico,
Thank you,
and
Leslie.
then drive to Tahoe the
Thank
next
you.
day. So,
Wow.
and then back down here and doing a presentation to Newport Beach on camp as well. So,
Oh, nice.
Cool.
yeah, hopefully it goes well. But thank you all, and anytime. You know, this week was a little crazy on the travel front, but anytime that you want us here or to do an update on the program itself, please let C know and I'll come down. So
Thank you.
thank you all.
Thank you.
Nice to meet everyone.
Fantastic, thank you very much. Item number 3 is the quarterly financial report ending June 30th, 2023.